All right, guys, welcome back to the channel. Trading Simplified. We're up to 323 subscribers. This is very impressive for me. I haven't had this many ever, so thank you for subscribing. Today, I just wanted to get into the March Fed meeting. I just wanted to talk about it a little bit because you need to think overall big picture here. And we're going to go through this article, just hit the key points, and then I'm going to show you a little chart that Fidelity shows you, which I think is very useful. And it's going to explain kind of how the market has reacted to increased Fed rates over time. So basically, it just talks about the Fed and your money and how the central bank's decision, what does it actually mean to you? So the big key takeaways is that the Federal Reserve, the main message is that they're going to continue raising rates. They're not going to stop. Every time Powell speaks, the main focus is hitting that 2% goal. So every month we get that CPI report where they get more data, they are still going to continue to raise rates. The Federal Reserve has decided to raise federal funds rate by 0.25%. So that means that right now we're currently in between 4.75 and 5% interest rates. So things are going to get more expensive. Now, what does that mean for an investor? This is not good for growth stocks. This is not good for companies trying to borrow money. This means that there's going to be more volatility. And anytime that they say volatility, they just mean that the stocks are going to sell off. It's a fancy word for saying if you hold stocks, they're most likely going to sell off. Does that mean it's a bad time to buy? In my opinion, no. It just depends on what your investment outlook is. If you're going to be holding for a few years, none of this interest stuff matters and you're getting everything on a discount. And that's how I look at it when I buy like the S&P 500 or the real estate fund that I just posted last video. So Fidelity offers just some insight on why the Fed keeps still raising rates. So during 2008, when we had that global financial crisis, we had unusual low levels of interest rates, and this helped boost stock prices. But now, as interest rates start to increase and they're getting higher and they're at that 5% already, with potentially raising them even more, which Powell said he will do, this is trying to fight inflation, trying to slow the inflation by increasing these interest rates. Fidelity offers a great graph that just shows the stock performance around federal rate hikes from 1950 to 2021. And this top part shows that 12 months prior to the Fed increasing rates, stocks were giving a 15 to 20% return, as you can see here. And then 3 months prior, they were still giving a 7% return. When the Fed announced that they were going to increase rates, you can see 3 months prior, you were only getting like a 2% return. Versus 24 months after, you'd get a 20% return on your investment. So although it looks pretty grim right now, if you're thinking just the short term, these are all buying opportunities, like buying the QQQs, the NASDAQ ETF, or buying the S&P 500. These are all opportunities if you can have a longer term outlook. So what's going to happen if Powell and the Fed continues to raise rates? This means that for stocks, U.S. stocks have all struggled. This just means that as rates continue to rise, earnings of many companies have been affected in the short term. And the reason is because their costs have risen with inflation. So it costs more money to borrow. Businesses have to borrow money to grow and expand the business, and they can't do that if rates are so expensive. If the cost of borrowing is so much more, that's going to withhold spending and borrowing money, which is bad. Everybody's waiting to see, is the Fed actually going to pivot and start cutting rates? And the market has been trying to factor this in, but I truly don't believe that they're going to cut rates. I think the Fed is going to keep going, even after the bank scandal, because a smaller bank, not a too big to fail bank, was struggling because they were mismanaging their money. You just have to think they're going to continue to raise rates, so just stick to the dollar cost averaging of buying what we were talking about. And I'll show some funds at the end of the video of what I'm buying every single week, because I think that these are all good discounts if you can think 3 to 5 years out. So basically, what do the higher interest rates mean for your money? This just means that savers, you're going to get a better return in banks because they're going to offer, 2%, 4% yields. But mortgages are going to be more expensive. Your auto loans more expensive to borrow. Student loans, if they ever start charging interest rates again, more expensive to borrow. Same for credit cards and personal loans. So I think what Fidelity does is, it was kind of nice they made an article like this because they're just showing you that rate increases are accompanied by stock market volatility, aka pulling back. The stock market pulls back. And in 2022, we had a brief 20% correction in the S&P 500, which is a buying opportunity if you're thinking long term. It could drop lower, of course, but if you're dollar cost averaging, you're gonna get a price at every high, every low, and it really doesn't matter at the end of the day. But these higher interest rates, they say, are no reason for long-term investors to abandon well-diversified financial plans. And that's the point of this whole video, is people always get afraid to buy when it's low. It makes no sense. If you saw a car that cost $10,000 and then it was worth $5,000 the next day and it was the same car, you would just buy the car. But when it comes to financially, people always worry when the stock market keeps selling off. If you're not retiring and you have 20, 30 years, this is a great time to be buying. Just keep buying. Just keep putting the money in every single week and just forget about it. That's my 2 cents. I just wanted to make this video because it just kind of recaps what the Fed's doing, how it's actually affecting you. And I think it's good to just always maintain the plan and forget the news and keep buying. So let me just show you a few of the investments that I think are worth it to just keep dollar cost averaging. All right, so I brought up 4 funds that I continuously invest in every single week. I don't even look at what the market is. I don't care what the price is. And I'll get a little more in detail, but the first one I have is SCHD. SCHD is a dividend ETF, and I have a video on SCHD, so you can refer to that under my playlist. But SCHD offers dividends, and it's got like 100 companies that are like the Home Depots, the Coca-Colas, that give you 3 to 4% every single year, and it grows over time. Then you have the S&P 500, part of Fidelity, which is FXAIX, that I invest into, that has a low cost expense ratio, the lowest I pretty much have ever seen, which is 0.015%, which means that you're only paying 15 cents per 1,000. Then you have Straight Technology, which resembles the QQQ, the NASDAQ. Fidelity offers ONEQ, just at a slight smaller expense ratio of 0.19. And then you have Fidelity's real estate, which I've been starting to invest in because they've sold off. It's FSRNX. Now, I'm not telling you what to buy, but there are clear times in the market where you want to be an investor. And when you click on things and you look into the actual history of them, and you can see that the charts have really sold off over time, but then you look at the overall macro, it just goes up over time. And ONEQ, for example, the NASDAQ, was at $63 at one point, and now is selling, a 20-30% discount down to $40. And you're going to continue to buy this over time. You look at the max of these charts, and it's like you wish you could have bought during these times when it was $10, $20, $30. And you're going to get dividends over time, and you're going to own a little bit of shares of these companies, of this like index fund ETF that holds over 1,000 stocks. And then they have all your big guys, the Apples, the Microsoft, the Amazons, the Teslas, the Nvidias. So you don't have to take on all that risk. You can own a little bit of each company and then just invest over time. And then you pay that little expense ratio, which is 0.89, I'm sorry, not 0.89%, that'd be a lot, 0.21%, and you get a dividend of 0.89. So it's all just perspective when you're looking at the market and it seems like it's red and you're scared to invest. If you think long term, it's a no-brainer. You're going to make money on the long term. You just got to buy and hold. Buy and hold over time. Look at this, the life of this ONEQ, the QQQ, the NASDAQ. You're getting the market return is 10, 11%. That's awesome. So it's just something I wanted to bring up with these Fed rates and what you could potentially be putting your money in. And if you want me to break down those in further detail, I'll gladly make a video on them and go through all the composition, the expenses, the ratings, the performance, just to get into it in further detail. But look at this, all the long-term sentiment from Fidelity is strong because they know in a few years, this inflation talk isn't even going to matter. It's just going to be a thing of the past that we spoke about where people wish they would have bought more and just held instead of trying to day trade every single bounce or dip. So that's my 2 cents for today. If you feel like you learned something, please subscribe and like to the channel and just share it with your friends because the channel's starting to grow, which is really nice. And I love getting comments and, suggestions back from you guys. All right, thanks.